2021. The CRAR at 16.1% at the end of December 22 is also much above the minimum regulatory requirement. Macro stress tests for credit risk indicate that scheduled commercial banks would be able to comply with the minimum capital requirements even under severe stress situations. Nevertheless, recent events in the banking landscape of the United States and Europe suggest that risks for an individual bank could crop up from segments of its balance sheet which might have been considered relatively safer. Hence, we expect the management and board of directors of each bank to continually assess the financial risks and focus on building up adequate capital and liquidity buffers even beyond the minimum regulatory requirements. And this is required for continued resilience and sustainable growth of individual banks and financial entities. Now, turning to operational resilience, let me say that operational resilience would mean that a bank should be able to deliver critical services even in face of disruptions. Cyber risks and possible cyber attacks are on top of the list so far as such disruptions are concerned. Cyber risk has been identified as the foremost in top 10 operational risks for 2023 based on a global survey of financial institutions. The Bank for International Settlements, that is BIS, while revising the principles for sound management of operational risks in 2021, introduced specific principle on information and communications technology, that is ITC risk management, reflecting the importance of this risk. Robust IT and information security governance would help in increased predictability and reduction of uncertainty in operations, minimize losses from information security related incidents, and enhance operational resilience. Given the extensive level of outsourcing being done by the banks and by other financial entities, there is even greater need for ensuring that effective policies and practices are put in place in this regard. Even the G20 finance ministers and central bank governors are focusing on risks arising from third-party dependencies. The Reserve Bank has taken a slew of measures in recent years with usage of advanced analytical and surveillance tools, along with techniques like phishing simulation and cyber reconnaissance exercises to push for enhanced IT and cybersecurity governance processes in banks as well as in other supervised entities. In the context of growing exposure of our regulated entities to various risks from dependencies on third parties which provide technology and IT-enabled services, the Reserve Bank has recently, that is on 10th April this year, just about 20 days ago, the Reserve Bank has on 10th April issued comprehensive guidelines on information technology outsourcing by banks, NBFCs, and other regulated entities. Now, the third component of resilience, I mentioned about financial resilience, organizational resilience. The third component of resilience for banks and others is to, I think I mentioned about financial resilience, operational resilience, and the third component is organizational resilience. So let me now focus on organizational resilience in brief. Banks and other financial institutions also need to be organizationally resilient so that they anticipate risks early and absorb them efficiently. Organizations must have the capacity and resilience to protect themselves from adverse incidents and shield their balance sheets. To achieve organizational resilience, regulated entities need to continuously evolve by standardizing policies, processes, organizational culture, and governance. They must also be flexible enough to encourage diverse ideas and innovations within the organization. You see, there is one thing, the institution by itself should have the inherent organizational resilience to withstand crisis. And I elaborate upon it a little more as I elaborate it, I will, delve in greater detail on this as we go forward. Now, let me just also, in this context, touch upon the pillars of Reserve Bank's regulatory and supervisory strategy. An important element of our strategy of making the Indian financial system, including the banking system, future-ready is the robust and enhanced regulatory and supervisory framework which we have put in place. Our present approach to regulation and supervision has been built essentially on three pillars. First, one of our focus areas in recent years has been to strengthen governance and assurance functions within the regulated entities. The safety and soundness of the banking system relies critically on effective governance so that interest of all stakeholders, especially the depositors, are duly safeguarded. The essence of good governance is to build an environment of trust, transparency, and accountability. Depositors, whose money represents an overwhelming part of banks' resources, keep their life savings and hard-earned money with the banks. Protection of depositors' money is therefore a sacred duty which has to be fulfilled through good governance. There cannot be any compromise on this. The Reserve Bank is very particular that regulated entities have systems and processes that promote sound corporate governance. The assurance functions, that is, risk management, compliance, and internal audits in banks are critical links between governance and business. Assurance functions assist the board as well as the senior management in gauging whether the business operations of the bank or NBFCs are being run in conformity with the policies and strategies laid down by the board. The Reserve Bank has issued detailed guidelines for ensuring quality and independence of the governance and assurance functions. These areas are also subjected to intensive supervisory assessment. Second, I talked about three pillars. This is the second one I am touching upon now. We have devoted our efforts to identifying and addressing the root causes of vulnerabilities in banks and financial institutions. Many a times, vulnerabilities arise from inappropriate business models. I mentioned about it earlier. It comes from inappropriate business models adopted by banks and other financial entities. Over-aggressive growth strategies, mindless pursuit of bottom lines, for instance, are often precursor to future problems. While we do not interfere with the business decision making in any bank or any regulated entity, we emphasized that they must demonstrate adequacy of internal controls and loss absorption capacity to match the risks that their business models may generate. Our approach is to flag deficiencies in this area to the senior management or to the board of directors of individual banks for remedial action. Remedial action has to be taken by them. Our job as a regulator, as a supervisor, is to point out our discomfort, our concern on certain aspects of their business model which may become a bigger risk, a bigger challenge, a bigger threat going forward. But the mitigation measure has to be taken by the management and the boards of banks. And it is our endeavor, it is our priority to engage with the banks and financial institutions and ensure that necessary mitigation measures are taken and are taken in time. Our approach is to flag the deficiencies in this area, as I said, and leave it to the banks and also engage with them to ensure that remedial action is taken. We also remain engaged with external auditors and flag issues that are relevant for their role as the third line of defense. In recent times, our focus on root cause has led us to mandate certain housekeeping hygiene, such as automated identification of non-performing loans and provisioning, proper checks and balances in the use of internal and office accounts, implementation of early warning systems for preventing frauds, and a host of IT and cybersecurity related controls, among others. The third pillar of our approach is within the Reserve Bank, within the Reserve Bank we have considerably strengthened our supervisory analytics. We are increasingly employing data analytics, both macro and micro, to capture potential and emerging risks, identify outlier entities, and the vulnerable large exposure of the banks. Our on-site supervisors deep dive into areas red flagged by off-site supervision teams. We are also focusing on the adoption of advanced analytical-based technological solutions, including artificial intelligence and machine learning, for strengthening the internal supervisory processes. We have a system of early warning signals that provide lead indications of risk buildup. Stress tests are also carried out on a continuous basis. These areas and these stress tests not only cover individual entities but also capture the system level stress. While asset quality and capital position indicate resilience and robustness of financial institutions in the medium term, liquidity is often seen as the immediate cause of a crisis. We monitor liquidity positions of our entities very closely, and aberrations, if any, are immediately taken up with the supervised entities for remedial measures. Thus, our whole approach to supervision has been proactive for minimizing surprises, spotting concerns, and addressing vulnerabilities early. In essence, the unification of supervisory architecture within the Reserve Bank, that is, by combining the supervisory processes of commercial banks, NBFCs, and urban cooperative banks into an integrated department of supervision. This is something which we did about 3-4 years ago. Earlier, we had a separate department for, as you would know, department of, there was a separate department for banking supervision, separate for NBFCs, separate for UCBs. Now we have combined them into a what you call a integrated department of supervision. So in essence, the unification of supervisory architecture.
हेलो चले
नेक्स्ट
लाइव पे है इम्पोर्टेंट है भाई
नेक्स्ट मिल रहा
हाँ स्टार्ट कर रहा हूँ ठीक है रिकॉर्ड कीजिए डॉक्टर शशि पाजा मिनिस्टर हैं चलो